Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then, Senthil Manikandan of Newberry Capital, T.S. Harihar of HRBV Client Solution, and Yogesh Mehta of Motilal Oswal Securities join us on the show. The stocks that we'll be discussing on Hot Money today are, we are asking our guest which is a better choice to pick between Exide and Amara, and also which is a better pick between Bharat and Motherson Sumi. We also discuss the buzzing stocks like PVR as well as Strides. The first stock that we want to speak about is the battery stocks. Overall, battery stocks have been rather stable of late, but which is a better choice in the battery space, Amara or Exide? So that's the question that we'll be asking our guests. So Hari, you go first. Overall view on the battery space and which is a better choice? You have a minute and then we'll come back to the detailed discussion.
Sure. So we actually like both the battery stocks, Exide and Amara, but given a choice, we would have a slight preference for Amara for a couple of reasons. And this is notwithstanding the fact that in valuation terms, Amara is a little more richly valued as compared to Exide. I think the two reasons we find Amara a better play. First is that if you look at Exide, it's still a predominantly auto battery play. And if you look at Amara, it's a smaller player in auto batteries and a larger player in industrial batteries. So I think that gives a more diversified view as far as Amara is concerned. Secondly, if you look at efficiency ratios in terms of cash flow per share or sales per share, Amara any day scores almost 3 times that of Exide. So I think if you consider both these, honestly, even at these valuations, we would have a slight preference for Amara over Exide. Also consider that Amara has corrected quite sharply from its peak. So I think at these levels, towards the margin of safety, it looks to be quite good for this stock.
Okay, so Amara is the choice that Hari is speaking at this point of time. Yogesh, what's your choice? Which one is a better choice for if someone wants to invest in the battery sector?
We like both the battery companies, Amara and Exide. Now, the edge over Amara would be at the current scenario would be Exide. We prefer Exide over Amara purely because since 2016 the new management has changed over. And there they've taken several initiatives for increasing market share, cost efficiency, and reducing in the cost side. So that all gives a better edge, and the market share recovery will be better for Exide industry in the automotive segment, as well as the right now they are the largest one in acid batteries. But given a new disruption in the technology, it will not affect any of the business for them. Plus the insurance business, which is at around 39 to 40 rupees per share, that gives the advantage. So on a valuation term, it is hardly 1p here or there, but we believe that Exide has much more to rise from here for compared to Amara.
Okay, so one Amara, one Exide. Senthil, your view on the battery space? Do you like the space? And given a choice to invest, which is a better choice for Amara or Exide?
So we like the battery space itself in the auto component space because they have a considerable B2C market, and within these two players, I think we could prefer Amara majorly because of the rise in lead prices. But if you see at the EBITDA level, actually there is a considerable difference between the two players. Amara EBITDA level is around 15%, while the Exide is around 12.5%. So Exide is improving its margins, but still there is a differential in the operational efficiencies, gives Amara an edge. And we are seeing that currently the market is moving towards electric vehicle. I think both the players are financially well equipped to garner more market share in the electric vehicle space, but we have to see how it unfolds.
Okay, so two of our guests do believe that, in fact, I think the consensus view is that the battery space looks good at this point of time. Two of our guests like Amara better than Exide. Yogesh is of the view that, Exide is a better pick. Yogesh, this insurance play, I think everyone values the insurance play, but there's nothing coming out of it. The company management is always saying that they're looking to monetize it or give shareholder value, but something or the other, they've never been able to deliver on that promise.
That is a concern over last 4 or 5 years now. But now increasing more active ratios onto term insurance and others, and the car insurance, non-life and life insurance. So there we have to give some kind of a justification on the balance sheet numbers that yes, the insurance is there. We have seen many companies which have come out with the IPO in the last 6 to 8 months, and they are valued at different share category. So we believe that Exide will also have to have that balance sheet number instead instead of valuing it 20 times just on the core business, that will also add some of the parts valuation. It should add some more into that. So insurance we have highlighted after these all new developments which has come in. That's why.
Okay, so Amara, Exide is the way. Hari, in terms of the demand as far as auto is concerned, do you believe that industrial demand will outstrip the auto demand? You said that auto is a small component, but industrial is something that you're betting on. So do you think that is that the industrial will continue to outperform auto in terms of battery demand?
See, eventually yes, because I think auto demand, the way the current battery demand is going and the way there is going to be a shift towards, driverless cars, battery-driven cars, I think unless both these companies are able to adapt to the new environment, it's going to be a challenge for both of them. Having said that, the reason I'm betting on industrial batteries more is that we have been through a very tough industrial phase in the last 3-4 years. And if you look at the IIP numbers, there are at least green shoots indicating that there could be a recovery in the capital investment cycle. And if that happens, I think that is going to be a positive as far as the demand for industrial batteries is concerned. So we believe that next 3 years industrial batteries actually could see demand outstripping the demand for auto batteries. So that is one of the reasons we have been betting on Amara Raja.
Okay, and Senthil, you said that you like the battery space as such and you like both Amara Raja. What's the key re-rating factors for both these counters going ahead? What could be the re-rating factor that could ensure that the traction continues for these counters? So
now if you look at the e-rickshaw space, actually there is not much considerable presence by both these players. So I think the e-rickshaw space looks attractive, and like Ari mentioned, the industrial space like solar and all of this industry, but there is a telecom looks weak from the industrial perspective because we are seeing consolidation in the telecom space, and the towers business is not doing well. So telecom is a bit lagger, I think. But apart from that, there is e-rickshaw plus other industrial equipments, I think, going to be the driver for the next 3 to 4 years. Okay. So I think the consensus that we are getting is battery as a space is doing well. All our guests like the battery space. Both Hari as well as Senthil like Amara Raja over Exide, while Yogesh likes Exide over Amara Raja at this point of time. But nevertheless, the space looks good. The next stock that we want to speak about is PVR. Surprisingly, the stock has corrected almost 20% from the recent highs. We are asking our guest, is it a good time to start accumulating PVR? What about you, Senthil? Should someone accumulate PVR? No, not at this current point of time. Okay. Because even after this correction, I think stock trades at a valuation of around 50 times this FY18 earnings. And if you look at the growth, has not been good in the last 3 quarters because the content offerings have been lackluster. Even in Q3, we saw footfalls have been dropping by 2% or something like that. But the company is expanding its theatres. I think they opened in the around 35 plus cinema halls in the 9 months period, and they have around 600 plus screens now. But at the other end, if you see the disruptions coming in from the OTT space, and the people have only a limited amount of space for media consumption, and with Amazon and Netflix, and their content offerings recently have been more of Indian oriented, and they are spending billions of dollars. So with limited time and things like that, I think the current multiple offers no margin of safety in the cinema exhibition business. Okay, so it's a no that's coming in from Senthil. Hari, right time to buy PVR, or would you go with someone like an Inox, which is also scaling up now?
No, I would agree with Senthil. We are cautious on PVR. We may possibly look at PVR a couple of quarters down the line once we are clear on how they are planning to monetize. See, the whole problem for PVR is it's still a Bollywood-driven business. I think 45% of that business comes from Bollywood. The whole problem last year was there's not a single blockbuster. And PVR typically makes money when there are blockbusters. And to create blockbusters, you need blockbuster stars. And all the 3 big stars, the Khans, are in the wrong side of 50s. So I don't know how much longer they can sustain blockbusters for PVR. So I think it's a very piquant situation. Secondly, look at how quickly a typical blockbuster movie comes on television. I think it used to be 1 year. Now it's about a month and a half. So people really don't see the need to go to a theater. Now, unless PVR is able to monetize other things like food, regional movies, Hollywood movies, I'm not too sure whether PVR is a stock we would like to take a buy call at this point of time. For us, at this point, we are neutral on PVR. Okay, what about you, Yogesh? Should someone buy PVR?
Darshan, we would suggest that yes, it's a good growth story because number one, in India, if you consider that if you go for your entertainment or partying, then you have only 2 choices. If your birthdays or anniversary, you'll go to movies or you go dine in. then this PVR is the largest market player with almost 630 screens for FY18, and as he mentioned, that 35-36 screen already added in 9 months, and aggressive plans are that for the fourth quarter, January to March 2018, they are adding 31 more screens. So this will add up more, and next year will be 690. South-based presence is that 67%, where we see, you know, any blockbuster or non-blockbuster, it gives a hit and the collection is roof crossing. So there we believe that PVR has got an edge. And nevertheless, the PE has been moderated now. It is at 35 times now at FY19 and would be 25 times for FY20 because of the growth. Plus GST on the food has also gone down to 5%, so that is giving also advantage to them. More than ticket, it is food which is providing, which is giving booster to the profits.
Okay, so I think Yogesh does believe that, you know, again, he's on the wrong side because the other two guests don't seem to be on his side. But we will throw it open. But Yogesh, the point what they made, and I want you to counter that, you know, I don't remember the last time I went to the theaters to see a movie. I have Amazon Prime, I have Netflix, I have Hotstar, I have my Tata Sky, I have everything. So let's say 5 years down the growth, where will growth come from? Because people are now shifting more to digital. People are watching Bloomberg Quint right now rather than normal TV channels. So everything's moving digital. So how will PVR sustain?
I hope if you start releasing movies on Bloomberg Quint, then that time we will sell PVR. But right now, as I mentioned, the 67-68% into the south side, and the content is improving, the footprint is improving.
South, there is a problem of price cap.
The price cap is there, but yet the average ticket price is around 210 to 212 rupees per ticket. Okay. They've got 133 lakh seats right now. Okay. So that is expanding many more. See, promoters has got vision. They are not into the thing that, you know, tomorrow this digital is taking, you know, the more market share and we should close down all this PVR. Rather, they are acquiring more and more into premium segment as the affordable segment, both the sides. Okay. So there we don't see any disruption that it will happen so far in very easy way. ROE is also around 12 to 13% right now, and will improve to 14% because of the improving EBITDA margin and the profits. So there we are firm belief that yes, PVR is in a right path. For at least 4 to 5 years, there is no competition for them, which is visible right now in any kind of OTT or in digital content. Ad revenue is also improving right now. So putting all the, if you go for a movie, you will see, you know, 12 or 13 minutes of a slot which is there pre-movie, and during interval you will see again 8 to 10 minutes of advertisement slot. So that is giving more to the revenues.
Okay. Okay, Senthil, I'll come to you. Do you agree with certain points that he's made? See, he's saying that, you know, South base there is growth, there is ads that are coming in. The F&B probably is one of the largest QSR PVR at this point of time. But with ROEs actually almost near double digit, it's not even hardly a double digit, and margins and valuations so expensive, would you be compelled to buy a PVR?
So look at the cinema exhibition business itself. It's a low ROE business because occupancy rate is around maximum it can reach around 30-32%, and if you look at the constant capex need to be spent on like renewing the existing screen and also upgrading and establishing new screens. So it's going to be constant capex kind of business. So we can't expect a high ROE kind of business from this cinema exhibition. And if you look at the clearly accept like F&B business, there is a scope for improvement, and in the ad business they are like in the top position compared to Inox. So they are monetizing this F&B and the ad business. That's a positive for them. But if you look at the footfalls in the India, like in the last decade itself, the footfalls hasn't moved anywhere. It has been either slowing or 2 to 3% is the growth. And PVR and Inox are growing on the back of the single screen theaters. So single screens have been losing market share, and these guys are garnering the market share. And only at a certain point of time they can grow this market share.
Okay. So I think the consensus view that the two of our guests are believing it's not the right time, but Yogesh does believe it's the right time, and to add to your advantage, I saw Raid a few days ago in PVR, it was jam-packed and the food was also expensive. So I think something must be working on what you're saying, but I think the stock market will decide what's happening. The next stock that we want to speak about is Strides. Now the count is down almost 15% from the recent highs. You know, the management had a meet, they've taken a lot of analysts to see the Australia facilities, and they gave a big vision as far as Australia business is concerned. But that doesn't seem to be playing. Stride is moving down constantly. We're asking, is this the right time to start buying Strides? Senthil, should someone buy Strides at this point of time?
Yes, sir, we think so. Majorly because I think their Australian business, which is the around 30% of their revenue, is on the verge of turnaround. And if you look at the Australian market, it's tough to penetrate for the newer players to come in because they have a vertically integrated pharma. And actually what Strides has done in Australia is remarkable compared to their earlier foray into the Australian market. And if you look at the US market also, they are a late entrant, but they are now concentrating or focusing on the complex products. So what we expect is going for the next 2 to 3 years, I think the regulated market share of the entire revenue pie is going to grow from 50% to 70%. So margin should expand considerably from the range of 15% currently to around 18-19%. So we expect PAT to substantially improve from the current levels.
Okay, so it's a positive view that's coming in on Strides. Hari, would you buy Strides at this point of time? It's 15% lower than what it was recently.
No, we like it. In fact, if you look at the last 1 year price, I think it's about 40% lower than the peak of about 1100 that it touched. So I think at about 700 and odd, I think the stock does definitely look attractive. If you look at it in terms of EV based sales, I think it is less than about 2.5 times EV based sales, which is extremely attractive from any pharma point of view. Also, I think the decision to hive off a part of their business, I think that's going to be positive as far as the OPM is concerned, also going to reduce the leverage. So I think if I was to bet on a stock in pharma, I think Strides Shasun definitely would be one of them. Also considering that 40% correction has happened from the peak price.
Okay, what about you, Yogesh? Strides, is it a good bet right now?
Is a good bet right now. See, the whole pharma pack is into a lull right now. Nobody wants to touch that because of the regulatory hurdles which is from US FDA. They have also got US FDA 12 times in last 3-4 years, but they managed to clear all those, almost all those. Even recently, it was in May 17, Puducherry and Bangalore facility. So it was a very procedural in nature. So aggressive filing, they have filed something like 7-8 NDAs in the last quarter, and total it will be yearly count would be 14 to 16. So that is giving advantage to them. Plus the recent approval which has come in the Sastiva. So that has got $7-8 million of sales right now in US markets, but at least that will give footprint to them. So price correction which has happened, so it provides a good opportunity. The growth will come. 360 crores of PAT of FY19 and 500 crores by FY20. So that gives a reasonable PE multiple for Strides Arcolab, and one can always look at buying these stocks.
Okay, so I think the consensus view that we're getting in on Strides at this point of time, it's the right time to start accumulating. We're running out of time, so we'll move on to the next stock. We won't have a detailed discussion, but I think the general trend, all of our guests spoke comprehensively and said that at this level, Strides look decent. And the last one we are talking about, again, we're doing a comparison between two auto ancillary giants, Bharat Forge and Motherson Sumi. We'll ask our guests to whether they like this space, and if yes, which is the stock that they would prefer. Hari, you go first. Do you like the auto anc space, and out of the two, which is a better bet?
See, frankly, we like both. In fact, Motherson over the last 15 years has had the record of making aggressive projections of 5 years and actually meeting them. So we like Motherson. If I was asked to compare, I would prefer a Bharat Forge for two reasons. One is in terms of leverage. I think Motherson is leveraged almost 9 times compared to Bharat Forge. So that is one concern we have over this company. Second is that I think the US truck business is dominated largely by Bharat Forge. I think that is not it, I would say, marked into valuations. So once you take that into consideration, I would believe that relatively Bharat Forge is underpriced compared to Motherson Sumi. So while we like the space, our preference would be for Bharat Forge.
Bharat Forge is the valuation. What about you, Yogesh? Do you like the space, and out of them, which is the better choice?
We like this
and
space
you can like both, there's no problem.
And we like both of them, and with the valuation multiple, it seems that both are now equally into price to earning multiple. They both are on the same pace, 25-26 times for FY19. Their EVs and auto connects and all these are providing good opportunity for them. And Bharat Forge and Motherson both have given last 5 years, 7 years, if you compare CAGR returns, they have delivered fantastic returns. So at this point of juncture on this debate, I would say both are equal good buy. The only thing is, my preference personal will go to Motherson Sumi because Bharat Forge has got a lot more dependency on the defense sector right now and class 8 trucks. So if something goes wrong on the European and US side, then it will be a dilemma situation for them. Wherein Mothersons have global presence, almost all of the Europe, and they have already ventured into the electric cars also, with Tesla as a new customer. So that is the advantage there. Otherwise, both are equally good.
Okay, so I think again we have a view where both of them are good. And Senthil, do you like like the space and which is a better choice and why?
Yes, we like both the companies, but on the valuation front, I think we like Motherson now after 20% correction. Basically, because if you look at the EV to EBITDA multiple for Bharat Forge, it stands around 20 times. And in the last 1 year, Bharat Forge has given a return of around 40%, exceeding the broader market returns. And I think the Bharat Forge from now business will perform well, but there is a little scope for re-rating for Bharat Forge. But on the Motherson, Sumi, I think if you look at their auto component business, well diversified. They have their SMP and SMR business in the Europe. They're the largest manufacturers in the rear view mirrors and kind of thing. So pretty diversified product mix that we don't see in the auto component space. Majority of the players are client concentrated or product concentrated. But Motherson, Sumi stands geographically diversified, and also product diversification leads to a good multiple for this stock.
Okay, so I think the consensus view again that we are getting is the fact that both the companies are better suited. They are both, all our guests are extremely bullish on both the companies, Bharat Forge and Motherson Sumi. We have an important management waiting by, so we'll have to wrap it up at hot money right now. Senthil, Hari as well as Yogesh, thank you so much for joining me on the show. But Coal India is the management. Coal India may soon lose its monopoly over the commercial coal mining in the country, but one of the largest miners, it has ample reserves and demand has also recovered, with power plants picking up more coal during the summer season. How will the current financial year pan out for the company? Joining us on the show right now is Chairman and Managing Director of the company, Gopal Singh, and Nikki Mirchandani, who tracks the sector very closely, will be quizzing the management. Nikki, take it away.
Thank you, Darshan, for that. Hello and welcome to Bloomberg Quint, Mr. Singh. I'd like to understand, to begin with, we'll like to start off with the production numbers, given that they have been on a declining spree. I'd like to understand, when can we expect an uptick in the production growth, and also are the rake issues, are we over rake issues right now?
See, regarding production, it has already picked up, and already we have more than 46 million ton of coal in our stocks at mine pit heads. And every day, in fact, production is more than your evacuation, I mean dispatch. Our dispatch is presently around 18.5 million ton, 18.5 lakhs tons per day. On days it has been 19 lakh as well. Whereas production has been in the range of 23 to 24 lakhs per day. So already production has picked up. It is much more than the dispatch capacity per day. And we have added to our stocks. This is plus 46 million ton.
Sure. Talking a little bit about your capex plans, believe the company earmarked a capex of around 15,000 odd crore in FY18. I'd like to understand what kind of figures are we working for FY19 and FY20?
See, we are targeting 1 billion ton of production in years to come. And because country is required to grow, power generation will grow in future. So capex, we have to expand, and we have to develop the system capacity to produce 1 billion ton. So capex in years to come, it will really increase exponentially.
I understand that, sir. I'd like to understand if you could put a number to this capex figure right now.
Next year we'll be looking for something 12,500 crores plus.
All right. Also, I'd like to understand, do you think company's cash balance, which currently stands at 312 billion in FY17, could further decline on account of rising capex and dividend payout?
No, I don't think, not at all. Because see, this year we revised the wages of our workers, which was due from 1st July 2016. So outgo has been quite good during this year. Next year, I mean, if you remember, price increase, it also came into effect from 9th of January, if I remember correctly, this financial year. So next year, that advantage will also be there. So next year, financially, it's going to be very good from Coal India point of view.
Right. Also, I'd like to understand, do you think the government focus on renewable energy will have kind of a risk in both in terms of your volume as well as pricing power? How is the trend shaping up for the next quarter?
See, I mean, as you quoted, there was a decrease in cost of production by rupees 53 a ton. And in days to come also, we are focusing on this reducing cost of production so that we can sell the coal at a lower price to consumers, because country's main thrust is to grow. inclusive growth. And for that, the essential requirement is reliable and sufficient power for the countrymen. So it's very good that there is a demand for electricity, and so is the demand for coal. That's a reflection of the economy also, that it's improving, it's growing. So that's a very healthy situation for the country, and particularly for the coal India. Regarding the threat from renewable energy, so there's so much of gap. If you look at the electricity consumption per capita in our country, it's almost 1/3 of China and about 1/3 of the world average also. So there's enough scope for electricity demand to grow. So once the renewable comes in, that's really will be good for the country, and coal has enough room to grow. So there is no threat to coal India as such as of now in near future.
Sure. Talking about cost of production, do you see the measures, what kind of measures the company would be undertaking to optimize the cost of production, given that diesel prices are on an uptrend? And also, are we expecting higher production cost going forward in the next quarter as well as the financial year?
See, we are looking for, extensive mechanization. We are looking for adoption of a state-of-the-art technology in our mines, and that will result in reduced production, reduced cost of production.
Sure.
It depends. Because if you take the third quarter results as an indication, there was a decrease by 53 rupees a ton. We are looking for, better numbers in years to come, in days to come. We will definitely try to reduce the cost of production as much as possible.
Sure. A follow-up on that, I'd like to understand, in the previous quarter, we saw the cost of production coming down by 53 per ton. Are we looking at a number higher than that in the coming quarter?
See, if you take the effect of inflation and if you consider all the other aspects, naturally there will be decrease in cost of production in years to come as we go for mechanization more and more, and reduce the manpower to the extent possible and improve the efficiency.
All right, Mr. Singh, thank you so much for your time. It was indeed a pleasure talking to you. With that, it's a wrap on Hot Money. Up next, please stay tuned to Bloomberg Quint.